Absolutely, let's do it. So very briefly, I'm a property finance professional. I've worked at the major banks for the entirety of my life, starting in Brisbane at the major top 4 banks, always doing investment finance, construction finance, popped over to London for a good couple of years and moved into the non-bank space. I've subsequently come back to Australia and again, staying in the non-bank stratosphere with Denning Investment Partners. So it's certainly an emerging sector in Australia at the moment.
And Denning Investment Partners, so it is a non-bank lender for particularly in the construction space. What does that mean?
That's correct. So the banks versus the non-banks is probably some terminology that you're hearing more and more. So I think we might deconstruct that today. The banks are getting more and more heavily regulated. They need to be unquestionably strong is what is the terminology APRA uses. So we can't have them defaulting. That you've got mum and dad investors. It's a big, especially the top 4 banks in Australia. They're the cornerstone of our financial system. And as we know, construction finance can have its risks. And the banks are lowering their leverage ratios. They may be increasing their pre-sale requirements. They may be increasing their interest coverage ratios for investment assets. And so slowly that just gets harder and harder sometimes for developers to actually procure finance from the banks. So this has resulted in the non-banks growing significantly over the last 5 to 10 years. The European US markets are significantly more advanced than the Australian market is. But you've got a number of non-bank financiers now in Australia, which I'm sure you've heard a number of them. Denning is one of the more boutique houses. We've got about a bill and a half of assets under management, and we like that size. It's a good, nimble size. We've got a team of 10 across Australia and New Zealand, and we actively manage our loans. So we can push the LVRs on projects. So say a bank on a residential construction project might be at 65% LVR, and that's loan to value ratio. We might push it to 70 or even sometimes 75% LVR if the project makes sense. And again, it's good sponsors, good projects, good people that we like to work with. So we do have flexibility around the credit framework, but nonetheless, our underwriting and our credit approval and investment processes are very rigorous, and we do analyse the transaction not too dissimilar to the banks, just more flexible on the covenants there.